Welcome to ECNTRADE Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you for joining me. So with the Christmas and the New Year celebrations for 2022 are slowly passing by, the market is now turned to the US session overnight, and as we can see, was very whipsawed as the dollar index, which measures the greenback strength against a basket of 6 major currencies, rebounded aggressively of the key level of 103 figure 15 or figure 20 area and rallied to a high of 104.62 to settle at 104.40. The market came to the response of the rally that the release of the minutes later on Wednesday could give further expectations of more tightening in store for the US for 2023. Investors will be closely watching the economic data released for the start of this month, and with that we could see further whipsaw price action as the US Federal Reserve continues to fight against 40-year high inflation and avoid tipping the US economy into recession, as it is expected to see a rate hike in February. In 2022, the US Federal Reserve raised its key federal fund rates 7 times, something it hasn't done that aggressive since the 80s. News sources also reported that the market anticipates a further chance in February, as I mentioned, of 68%, that the Fed will raise rates by 25 basis points to 4.5 to 4.75%, with the peak rate around June close to 5%. Meanwhile, there are several big updates this coming start of the month, with the US employment front looking to the non-farm payrolls. As I mentioned before, we also have the minutes from the US Federal Reserve from its last policy seating, which was in December, which could explain a great much still, and along with the hike in interest rates by 50 basis points instead of 75, which was anticipated. Then, as I mentioned, we've got the crucial US job report, which is the non-farm payrolls, which should highlight the nation's labour market in terms of 2022 and see how strong it actually is, despite the most aggressive monetary policy tightening that we've seen in a decade. Looking at the dollar to the Australian, that is, we can see that the top side rejection, which was a key level at 68.45.55 or close to there, has ended posting an engulfing candle, which now awaits confirmation. That confirmation is still a little way to the downside, and that is at 66.60. A break there would see further scope towards the 60-day moving average, which is close to around the 66-cent handle. It would be pretty bearish if we do see the break and confirming the engulfing candle, but there's still a little bit more downside to tackle before even exploring beneath 66 cents. Technicals have buckled since the downward slide, so let's see if we do get the confirmation or if the market bulls are further determined to take that challenge back towards 68.45.55. But given the sharp sell-off, we could see a little bit more stop lossing coming into play. Euro, the market backs away from its objective, which was seen roughly around that 107.20 area, and now back towards the downside and crushing the level of 105.70. From that, the market is still somewhat buckled and negative due to the heavy candle that we saw here. If we can see a break back above 105.85, that could give a little bit more scope to the upside to 106.40.45 and maybe even negate this key level of that was the support at 105.70. Let's see how the market is now probably likely to see a little bit of thin trading due to the start of the new year. Dollar yen, well, the market did take the challenge to that key level, which is around 130.5 and rejected, and has posted relatively a strong candle, either close to the hammer or not too far away from the dragonfly doji. We do need confirmation to this engulfing candle, and if we do see a break above the level, which is roughly around 132 figure 15, then I feel the market may reinstate the bullish case and up towards the region of 134 as a potential target. Sterling, not as weak. It did take the challenge towards that level of 119.60, but just managed to hold above there from the close of New York. Nevertheless, the technicals are negative. Let's see if we get another challenge to that 119.60 level, and a close beneath there would reverse the recent gains and see losses towards the region of 118.45 and reassess. To some surprise, considering that the dollar index rebounded close to 120 to 140 points, is the gold still took the challenge higher and getting very much close to its objective, which is seen around 1,854 to 56. I'm not a bull at these levels, and I'm a little bit cautious because if the dollar does increase from where it is at 104.40 and on towards 105 to 106 or even to 107, depending on how strong the momentum is, since that rebound off the key level of that 103 figure 15 area, is that we could see a tumble back towards the bottom side, which currently sees around 1,806.208 and reassess. But the technicals are a little bit firmer still for gold, with the ADX trending to the bullish case. Disappointing for oil as it backs away sharply from that key level of $81.30.40 and posts an engulfing candle that now gives further scope to the downside. From the rejection from 81, we do need confirmation to this engulfing candle. And if we do see a close underneath the level of 76.40.45, then that would give further scope to the downside to 73.5 and reassess from there. The technicals are negative, so therefore could see a little bit more pressure on the support level. As I mentioned, 76.40 to 55 is a key point to confirm this engulfing candle and to support further downward potential. Well, that wraps it for today. Thank you very much for joining me, and as always, look out for the intraday report, and I hope you enjoy the great start ahead.